Ladies and gentlemen, good day and welcome to the DCM Shriram Q4 FY23 earnings conference call. As a reminder, all participants' lines will be in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note this conference is being recorded. I now hand the conference over to Mr. Siddharth Rangnekar from CDR India. Thank you, and over to you, Mr. Rangnekar.
Thank you. Good evening and welcome to DCM Shriram Limited's Q4 and FY23 earnings conference call. Today we have with us Mr. Ajay Shriram, Chairman and Senior Managing Director, Mr. Ajit Shriram, Joint Managing Director, Mr. K.K. Kaul, Whole-Time Director, and Mr. Amit Agarwal, CFO of the company. We shall commence with remarks from Mr. Ajay Shriram and Mr. Ajit Shriram. Members of the audience will get an opportunity to pose their queries to the management following these comments during the interactive question and answer session. Before we begin, please note that some of the statements made on today's call could be forward-looking in nature, and a note to that effect has been included in the conference call invite circulated earlier. I would now like to invite Mr. Ajay Shriram to give us a brief overview. Over to you, sir.
Thank you, Siddharth. Good afternoon, ladies and gentlemen. Thank you for taking the time to join us for our Q4 and financial year 23 earnings conference call. I trust each of you and your families are keeping safe and are in good health. I will commence with the strategic imperatives of our businesses, followed by Ajit with perspectives on our business performance. India is growing steadily at a reasonable rate of over 6%, in contrast to developed nations that are facing headwinds of high inflation, rising interest rates, and slowing economy in the wake of unprecedented disruption over the last 3 years. So India is in a comparatively sweet spot. We have consciously planned for managing higher volatility in key business lines and have strategically lined up effective measures in the form of higher scale, efficiencies, and diversification to create better value in our businesses. We continue to look at growth through already announced investment programs, and more are expected to follow. Our capex projects of rupees 530 crore have already been commissioned relating to sugar businesses, and other projects of about rupees 2,900 crore, largely in chemicals, are likely to be commissioned over the next 2 quarters. Our less capital-intensive businesses of Fenesta and Shriram Farm Solutions are witnessing good growth. With this round of capex earnings completion, we are actively looking at opportunities in related and adjacent businesses for future growth opportunities. Our efforts on sustainability are gaining traction. We are taking steps to enhance our share of green power while working actively on the circular economy. The 50 megawatt hybrid green power project and the increase in biomass in a coal-based power plant will increase our green footprint as well as help us in reducing our cost of production. The K2SO4 fertilizer project will add value to our distillery ash and is an import substitution. The anhydrous sodium sulfate and carbonization of sludge will reduce waste and improve resource utilization. The energy and steam saving initiative will further reduce our carbon footprint. Some of these benefits have already started accruing. With this, I would like to walk you through our views on various businesses. First is chemicals. Global capacity utilization, especially in Europe and China, has picked up, although global demand remains subdued, driven by growth slowdown across large economies. This has put pressure on international demand and hence prices of caustic soda. No major capacities are being added globally in the near term other than in India, which will keep the global demand-supply balance over the medium term. Domestically, the demand trend was softer owing to weaker momentum in end-use industries, especially alumina. We have seen stable demand for chlorine. New capacity additions are exacerbating the situation. Product prices have softened over the last 2 quarters. Energy prices have started to decline, but are still quite high. Our capacity utilization stood at 89% in financial year 23. The country saw exports of 4.24 lakh metric tons during financial year 23, up from 2.71 lakh metric tons in the last year. Imports stood lower at 1.39 lakh metric tons in financial year 23, which was 2.34 lakh metric tons in the previous year. Our Bharuch facility is amongst the highest hydrogen selling complexes in the country, with daily volumes of 2 lakh cubic meters and further being expanded to 3 lakh cubic meters per day. Our projects for developing downstream chemistries, including expanding scale, are on track, and the plants will be commissioned during the next 2 quarters. Lower coal prices, efficient 120 megawatt power plant, and access to green power will serve as a cushion on the margin in light of softer product prices. Chemicals is becoming a large multi-revenue business with emerging growth platforms like epichlorohydrin and hydrogen peroxide. Vinyls. Globally, the dual impact of inflation and high interest rates is leading to slowdown of housing and construction in US and Europe. Even in China, the real estate has not picked up. This has led to lower demand for PVC globally and significant drop in international prices. Domestically, the economic activity is robust and so is the PVC demand, but imports are trending higher. The industry awaits government action in the form of anti-dumping duties and increasing customs duties. Prices for both PVC and carbide are under pressure. Cost of production stood higher due to coal and carbon material prices, but have started correcting slightly and will ease pressure on margins in the coming quarter. Sugar. International prices have been firm on lower production expected from major producing nations and with prospects of additional exports from India also abating. World sugar balance sheet is expected to be marginally surplus in sugar season 22-23. International prices are expected to remain firm. Indian sugar stocks are expected to end lower at 4.5 million metric tons for sugar season 22-23, with sugar production estimated now at 32.4 million metric tons and consumption at 27.5 million metric tons. This, along with higher international prices, should support domestic sugar prices in coming months. The state of UP increased the state advised price, SAP, by rupees 25 per quintal to rupees 350 per quintal in 21-22. The domestic sugar prices have till now not offset the increase in sugarcane prices done in the last season. We are on the verge of concluding crushing operations. Our crush and recovery this season is expected to be higher than last season, led by better climate, commissioning of our Ajbapur expansion, and conversion of Ajbapur and Haryana sugar factories to refined sugar. Our domestic releases have been better this season, and we have already executed the entire export quota allotted to us. On the other hand, the government has achieved ethanol blending of 11.6% as of April 23 and is aggressive in meeting its target of 20% by financial year 25. Around 408 crore liters is said to have been blended in petrol in the supply year ended November 22, and the contracted volume for the coming year is 505 crore liters already. We have produced 14.4 crore liters of ethanol and ENA versus 11.56 crore liters last year. We have commissioned a 120 kiloliters per day distillery on molasses feedstock, and the 260 kiloliters per day grain-based distillery is ready. The approval for commissioning is likely in this quarter. Our other agri businesses comprise of Shriram Farm Solutions, Bioseed, and fertilizer. First, I'll touch on Shriram Farm Solutions. The business has worked well in consolidating its leadership in wheat seed. Its research and development has started yielding results with 4 new products introduced this year, including 2 in wheat seed. All the products have been received well. Growth in this business will continue from the planned expansion of portfolio, manufacturing of crop protection chemicals, which start this year, and further cemented by our foray into manufacturing of water-soluble fertilizers and biologicals by Q4 of financial year 24. Our manufacturing of biological-based agri-inputs is our conscious choice to work on new technologies and also promote sustainable and organic farming. This business is also increasing its geographical spread and is making inroads in southern India. Bioseed, I'd like to talk about that. Bioseed is on track to turn around its business. The losses have come down significantly. Product pipeline is more focused. Product basket of research activity is being rationalized, and we expect the business to do better in the coming year. The fertilizer business has seen a correction in urea prices during the quarter, led by lower energy prices. The government has revised energy norms with effect from October 1st, 2020 till March 31st, 2023, and our energy efficiencies have also been better. The subsidy outstanding as of March 31st, 2023 stood at 310 crores as compared to 435 crores last year. The Fenesta Building Systems business is witnessing good momentum quarter on quarter. The project segment is driving good growth. As the core business expands, we are adding more categories, adding new offerings, and increasing our geographic spread, including in the international space. We have added products in UPVC and aluminum windows, in WPC and engineered wood doors, and will be launching glass facades and also continue to add further to this range. In view of the rising demand, this year we commissioned our Bhubaneswar factory and added one more factory in Hyderabad. We are commissioning an expansion at our Kota extrusion plant. The fabrication unit for facade is under construction and will be commissioned by Q2 financial year 24. Our growth strategy is underlined by well-executed initiatives towards business expansion and product diversification, along with enhancing operating efficiency. We see our businesses of chemicals, sugar, Shriram Farm Solutions, and Fenesta as key drivers for our growth going forward. I will now request Ajit to give you the perspective of the business performance. Ajit.
Thank you. Good afternoon, everyone. We will now go through the business performance for Q4 and FY23. The net revenues, net of excise duty quarter, were flat at 2720 crores versus 2796 crores in the previous year, and PBDIT stood at 372 crores, down by 44%. Chlor-alkali business revenue was down 13% year-on-year, and PBDIT was also down 53%, mainly due to lower ECU that declined 17%, though volumes were marginally higher. Higher energy costs impacted the margins. Also, the electricity duty on auxiliary consumption had an impact of 11 crores related to prior periods during the quarter. Vinyl business revenue declined by 44% year-on-year at 168 crores, and PBDIT was at 1 crore versus 122 crores on account of lower product prices and volumes. PVC prices were down 35% year-on-year, and carbide prices were down 26% year-on-year. Overall, capacity utilization was lower at 91% versus 96% last year. Higher cost of product led by power and carbon materials impacted margins. Also, electricity duty on auxiliary consumption related to previous years had a negative impact of 10 crores during the quarter. Sugar business revenue, net of excise duty, was up 24% and PBDIT increased by 10% year-on-year on account of higher volumes of sugar and distillery coupled with higher realizations. Margins were lower since the last year's increase in SAP is not compensated by increase in product prices. In terms of crush, we are likely to close this season at about 650 lakh quintals versus 549 lakh quintals last season, attributed to better crop and commissioning of sugar projects. Sugar recovery till date on final molasses is better by about 20 basis points over last year. Fenesta Building Systems revenue reported a growth of 13% year-on-year and PBDIT was stable. There was volume increase in the project category. Margins were better in projects as well as retail categories. Both categories witnessed improvement in order book that was up 10% year-on-year. Shriram Farm Solutions revenue and PBDIT witnessed a decline due to seasonality factors. For the year as a whole, the business witnessed growth. Fertilizer revenue declined by 4% year-on-year, driven by lower gas prices, which is a pass-through. Volumes were higher by 4% year-on-year. PBDIT witnessed a growth of 44% owing to higher energy efficiency, energy saving rate, and volumes. Fertilizer subsidy this year was lower as stated earlier. Bioseed revenue is better, however Q4 is an off-season. PBDIT improvement was led by higher volumes and inventory provisioning in last year. Coming to the highlights of FY23. FY23 net revenues, net of excise duty, was up 20% year-on-year at 11,547 crores and PBDIT down 9% year-on-year at 1,726 crores. Chemicals revenue and PBDIT were up 27% and 15% respectively due to better ECUs led by prices of lye in the first 9 months of the year, an improvement in chlorine prices and improved volumes of caustic. Margins were moderated by higher input costs. Vinyl revenues and PBDIT were lower by 31% and 84% respectively, led by significantly lower prices. Volumes were also lower. Margins were further affected by higher input costs of coal and carbon materials. Product prices seem to have bottomed out and coal prices are declining. This should help margins going forward. Sugar business revenues were up 21%, mainly on account of higher domestic and export volumes of sugar, together with better prices across products. Distillery volumes were stable at 11.87 crore litres versus 11.95 crore litres. Production from distillery was higher as stated earlier. PBDIT was lower by 20% since the sugar prices increased that did not fully compensate for the increased SAP in the earlier season and non-availability of purchased molasses from the market. Better export realizations added to the profitability. Fenesta also reported a good performance. Revenues and PBDIT increased by 32% and 70% respectively. This was on account of a strong order book, which increased by 23%, and growth in volumes in projects and margins across categories. Fertilizer revenues increased 50% year-on-year on account of higher gas prices, which is a pass-through, and better volumes. PBDIT was up 62% with energy efficiencies, better energy norms, and a higher savings rate as a result of prices of natural gas. Shriram Farm Solutions revenue and PBDIT were up 7% and 37% respectively, aided by an improved product mix and better prices. SFS witnessed healthy margins across categories and remains the leader in wheat seeds. Bioseed revenues were up 19% and PBDIT was at -2 crores versus -70 crores on account of better volumes. PBDIT was also better due to higher inventory provisions made in the last year. Our income tax payout was at rupees 246 crores as compared to a tax charge of rupees 502 crores as a result of MAT credit available. With healthy cash flows across our businesses, our debt levels remained at comfortable levels despite the continuing capex. Our net debt as on 31st March 2023, rupees 681 crores as compared to rupees 4 crores on 31st March 2022. Return on capital employed for March 23 came in at a comfortable level of 27%. The board has recommended a final dividend of 180% amounting to 56.14 crores in this board meeting. The total dividend for the year is at 700 crores amounting to 218.32 crores. Despite the macroeconomic concerns and higher input costs, our company has had a good year. That concludes my opening remarks, and I would like to request the moderator to please open the forum for the Q&A session. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask question, please press star 1 now. We take our first question from the line of Ria from Aquitas Investment Consultancy. Please go ahead.
Hello. Thank you for giving me the opportunity. My first question would be in terms with Finistar. So basically, the order book has grown by 10%. However, in the past few quarters, was going on a higher run rate. So what exactly, how is the demand scenario panning out there, and what is the situation for Finistar?
Can you just repeat the last part of the question, please?
Hello? Yeah,
Can you just repeat the last part of the question on Finistar?
So I want to know the demand scenario as well as the margin impact for the quarter. Why were the margins lower with the lower raw material price?
So see, the demand is pretty stable, right? Although in this segment we are seeing competition coming up from larger players as well, but Finistar continues to remain the pioneer and has a big brand value. That is point number 1. Second, coming to the margin has come off, I think, by about 1%, from about 21% in same period last year to about 20%. That's, I would say, very marginal. But fundamentally, as I had also mentioned in my last call, that business like Finistar should ideally have a margin in the range of around 15 to 20%. So let's say ballpark 17%. That's the right kind of margin for this business.
Okay. Is it because of higher competition? Because since the raw material prices are getting lower, so we should see an improvement in margin on a QOQ basis.
As I said, if there is a reduction in raw material prices, some part of it will be passed on to consumers as well.
Okay.
So I don't see margins improving from here.
Okay. So Q4 numbers are sustainable.
Yeah.
Okay.
And as I said, I said the range should be around 17% plus minus 2%. That's the right number. Because if you see in FY22, the margin of this business was 16%. So that was closer to, the right kind of number.
Got it. And with increasing competition, do you think we will have a price war kind of a scenario where we have to reduce prices more?
It's difficult to say at this stage. Depends. They have just started, so we'll see how it pans out.
But I'll just add that, I think Finistar's position in the market is fairly sound, leader in the market. And the good thing is the market is growing. So I think there's space for everyone. But it depends a lot, of course, on the product quality plus the service. How do you take care of right from the time you book an order till the time you install and commission and hand over the door or window to the customer? So I think we have a good edge there. So that's a positive sign for us.
Right. I think this makes sense. My second question is in regard with the sugar sector. So basically, what was the cost of production for us last sugar season, and what is the cost of production for us this sugar season?
Yeah. So the cost of production last season was around 3,300 per quintal. And this year, March end was about 3,210, 220 per quintal.
It is reduced?
Yeah, because as you mentioned that our production is higher and secondly our recovery is better by about 20 basis points.
Okay. However, I was reading that in UP the wage norm has increased and there are a lot of ancillary cost which has piled up. So what kind of impact is there on the cost of production? Is the cost of...
So it could have been further lower, has those been maybe by about, I don't have the number exactly by how much, but marginally lower definitely. But that's our cost.
Okay, that's good. And in terms of production, what kind of acreage increase have we seen for the current year? Acreage or production in terms of...
I don't have the acreage number, but the crush is 650 lakh quintals of sugarcane that we expect. We are nearing that number by the time our mills close.
Okay, and when are we expected
versus 549 which we did last year.
Right. And mills will close by May?
So out of 4 mills, 3 mills have closed. 1 mill which is operational will close in next 3-4 days.
Okay. And in terms of the current rainfall, which untimely rainfall, does it have an impact on the crop?
I think it's a very positive thing as far as the crop is concerned. In terms of we've had a very dry winter spell, so any rainfall is always welcome because this aids the farmer in terms of irrigation free of cost virtually.
Okay, got it. My second question is in terms of ethanol. What is the kind of offtake are we seeing from the government, and what are the current volumes and the next year volumes we are wanting to do with the enhanced capacity from Q1 FY24?
Yeah. So in terms of offtake, you're talking of the industry level offtake?
Yeah, industry as well as for DCM.
Yeah. So industry level offtake, as CMD mentioned, the total contracted quantity this season already is about 505 crore liters. And for us, in the coming season, we have the capability to produce 18 crore liters. Last year we did about 14 crore liters. Next year we should be progressing towards 18 crore liters.
Okay. And industry-wide offtake last year would be around?
I don't have the figure. Yeah, 404. Yeah, I think that's what CMD has said. It's about 404 crore liters.
Okay. In terms of diversion, on an industry perspective, I think 4 million ton is the amount we are seeing this.
Yes.
Yeah, if I'm right. This was last year around 3.5, right? 3.4 or something.
3.5.
Okay. And for ethanol, what would be a transfer price, molasses, and are we doing juice-based or how is it?
We are producing primarily on B-heavy. We have done a small experiment on juice-based as well, but primarily it is B-heavy ethanol. Transfer price, I think, I think one should look at overall, if I sugar as a business, every company might have their own transfer pricing mechanism as per the accounting standards. So I think we look at it as the sugar business as a whole because it's very dynamic, whether we produce B-heavy or we produce C-heavy or, different feedstock mix.
Right. And in terms of the ACH demand that we are hearing about, the epoxy, we are hearing that the demand is decreasing and there are a little sluggish outlook on the entire space. So what is your opinion around it?
See, I think these businesses we are getting into, which will come in the next couple of quarters. It will take a little while to stabilize the plant. But, our way of looking at business and industry is we're not in it for the short term. We are in it for the long haul. and our objective is to come up with a class product and supply to customers who are satisfied with our product. So markets ups and downs are part of the ball game. We've seen that in every industry across the board. So we are quite bullish on the long-term positive, medium-term positive impact of ECH and H2O2 as our growth plans go forward, because of the plants we are putting up, the technology we've got, and the team of people we have who will make sure that the plant runs efficiently, and we have a good relationship with our customers.
By when do we expect the plant to be commissioned or stabilized?
Before the end of Q2.
Okay, I think that's it from my side. I'll join the queue for further questions.
Thank you.
Thank you. To ask question, please press star 1. Take the next question from the line of Amit Mehta from Unifi Capital. Please go ahead.
Thank you so much. My first question is on the cement business. So this year we reached close to 50 crore loss. I know that we set up this facility about 35 years back. So I just wanted to understand rationale how this business has relation with our chloro-vinyl business. Does any byproducts are used as a raw material for this? Can you give some clarity? How was this business initiated?
So, see, cement business is essentially waste utilization or, the waste that pollution control mechanism in a way, because the sludge that gets generated on when we manufacture PVC through carbide route, that sludge goes into cement for conversion. Right. So I think we at least look at it like that. Yes, there have been times when cement has given us reasonably good profits. And now, because we are on a wet process, our cost of production is higher vis-a-vis our peers, and therefore, the realizations are not commensurate with cost. I think the way one has to look at least for us, the way we look at it, it's a pollution control or waste management mechanism.
Okay, got it. And is it expect that with the coal prices coming down and even the cost of production for a vinyl business coming down, the losses will reduce going forward?
See, the chemicals and the vinyl business are not into losses. Whether the margins will improve or reduce will also depend on how the prices move. But yes, the costs are expected to come down definitely going forward.
Got it. I have a few questions on the sugar business. So number one, how much exports we are supposed to do in April or even Q1 quarter? I think we have done about 8.5 lakh quintal till Q4. So how much is left for Q1, April month?
There will be some. We have completed everything by April. That is point number one. And I think I don't have the exact number, 1 to 2 lakh quintals. 1.2, 1.3 lakh quintals is what we exported in April. And that ends our export quota.
And this was at what prices?
Around 40 rupees a kg.
Okay, got it. And another question on the ethanol side. So we did production of more than 14 crore liters and our sales was 11.8 crore liters. So what explains this difference? And for the next year, how should we look at the ethanol total production with the grain-based facility also coming up?
So these are timing differences based on tenders and things like that. So that gets covered up. This quantity will get sold. So this is all committed, contracted kind of thing. These are timing differences, as I said earlier. That is one. Second, with grain-based distillery coming in, so our capacity to manufacture goes up to 18 crore liters. So we'll try to maximize that.
Okay, got it. And how much sugar production we have done so far in Q1, roughly?
In Q1?
Yeah.
I think you can. Okay, I don't have the Q1 numbers. When the Q1 you're saying for this month, or let's say month of April, right?
Yeah, correct. Yeah, for this month.
I don't have the month number right now.
Okay, fine. No.
I'll share it with you, Ahmed, after the call.
Yeah, no issues. Fine. And the last question on the caustic business. So with the caustic prices coming down further in March and then in the April month, it is expected that obviously the realization ECU will go down. So I have two questions on this. Number one, how is the chlorine pricing as of now in the market? And number two, with the coal prices also going, how should we look at the profitability for the caustic business? Do you expect that there will be from Q4 base there will be further significant decline, or do you see that the decline in the caustic prices will be offset by the decline in the coal prices and then our power plant coming up?
See, the situation is very dynamic right now, Ahmed. We do expect prices to improve from H2, right? At least that's what our marketing team estimates. Right? At least in H1, we expect them to be under stress. Costs are coming down, but we've seen coal prices, they were low in March. In April, actually, they picked up marginally. So it's a really dynamic situation. So it will be difficult to really comment. We also will have to, just watch the trend for 1 or 2 months, and then we'll be able to give better guidance.
And any comments on the chlorine pricing?
Yeah, chlorine is still negative, but it's not that bad. Like in Q3 last year, it was almost 10,000 negative. Now it's about 3,000-4,000 negative.
Okay. And how much exports we did for caustic in Q4?
How much exports for us?
Yeah, for caustic, for DCM.
I won't have the export number for this quarter.
Okay,
yeah, I won't have that number right now.
We can connect later. Thank you so much, sir. That's it from my side.
Thank you.
Thank you. Participants who wishes to ask a question may press star and 1 on their touchtone phone now. We take a next question from the line of Vivek Ramakrishnan from DSP Mutual Fund. Please.
Good evening. My questions are around the capex. I'm sorry I joined a little late if I missed the number. What is the balance capex in terms of amount that is be paid off, which is there in the current year? And where will your peak debt levels be? That's my only question, sir.
Yeah. So see, the total capex program that we had was for 3,500 crores.
Right.
Now, out of this, we have already commissioned close to about 600 crores, 530 crores in sugar, and about 60-70 crores in chemicals. So we left with 2,900 crores. Now, what we've spent till date is close to about 2,500 crores, approximately 2,000 crores, and on projects. So we have another 1,500 crores to go in the next financial year, which is FY24. And our peak debt, as I see, net debt by March will be in the range of around 1,500 to 1,800, 1,900 crores. That's the range.
Okay, sir. Thank you very much and wish you all the best.
Thank you.
Thank you. We take a next question from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Yeah, namaskar, sir. Just to clarify the last number once again. So when we look at your capital work in progress, it stands at 1,600 crores. So, and I think the 530 crore sugar capex will be accounted for, has been capitalized in the first quarter. Can you give this in relation to the number of capital work in progress? How is this number going to shape up?
Yeah. So I think you read it correctly, Saket. As I mentioned, we have spent close to about 2,000 crores, right? And 600 crores is what got capitalized. So balance is close to about 1,500 crores, which is standing in favor.
So sugar we have capitalized in March itself?
In Q3 and in Q4.
So that 530 has been capitalized. So sir, this 530 capex, how is it going to contribute going ahead? What will be the turnover ratio?
See, the 530 crores of capex should give us a ballpark return of close to about 20%. I think we should live with that.
So the turnover will be at what? For 530 crore, what will be the asset turnover ratio?
Turnover is that, because see, there are some measures where our refinery capacity has gone up. There are some measures where our feedstock has improved. I mean, the feedstock is a bigger feedstock on grain, right? So there are some dynamics which will support cost, and there are some dynamics which will support sales.
Correct, sir. Sir, in the presentation also, the mention about 120 megawatt power plant is also mentioned. So, what would be our annual savings and the commissioning of the same?
So, this 120 megawatt power plant, the total project cost is close to about 550 crores. And we expect this to give us savings in the range of around 100 to 125 crores on an annualized basis.
So, we will be getting the benefit for the entire full year, or this power plant has been commissioned, or what is the update?
So, as CMD mentioned, the power plant is expected to be commissioned by Q1 end.
Okay, for 9 months we will be getting the benefit of the same in pure database.
It takes time to ramp up any large project.
Correct. Yeah. Correct. So on a full year basis, it will be 100 crore savings that we will be expecting from next year onward in totality.
Yes.
Sir, in the opening remark, MD sir, you mentioned about some hydrogen production part. I missed your comment on the same. What were you trying to convey for the Bharuch unit? If you could elaborate more, sir.
No, just to clarify, when we make caustic soda chlorine, another product which is made automatically in the process is hydrogen.
Correct.
So today we make about 2 lakh cubic meters of hydrogen per day. Now once we commission our expanded capacity at our Gujarat factory, we will come to almost 3 lakh cubic meters of hydrogen per day. And we are selling this. So that is also a good source of revenue for us.
And sir, turnover-wise, can you give an yearly number for the same? What have been the contribution from the sale of hydrogen?
So, last year, we had a turnover of about 155 crores on account of hydrogen, and our sale was close to about 2 lakh NMQ per day. And EBITDA on account of that is about 129, 130 crores.
Okay. On a sale of 150 crores?
Yeah.
Right, sir. Sir, one more point about this ESOP part. If you could explain to us, why did we choose this route of creating a trust and then buying the shares from the market, and then rather than going for direct ESOP, what have been the differentiations, sir?
So, Saket, this is an old policy, existing policy that we have, which we had framed in 2013. The policy is continuing. We already have shares under this policy, which is reflected in our balance sheet as well. We are just adding shares for the benefit of the employees.
Right, sir. But the other route of direct ESOP credit coming, why? Because
yeah. Saket, I don't think I can do the discussion here, because these are longer discussions to explain what is the difference between an ESOP and ESPS, what are the benefits.
Right. I'll conclude with my last question, sir. So, taking into account the commentary and the type of capex that we have envisaged, going ahead for this year, we will be starting to reap the benefit of the entire capex for the chemical segment, or it will take another 1 year for the entire thing to capitalize. And I just missed I want to understand the figures for FY24. What are the key figures going on?
As I mentioned earlier, Saket, we expect all our chemical expansions to be completed by the end of Q2, financial year 24. Now you will appreciate whenever an expansion is done, especially new product line comes in, one can't expect that within 1 week you come to 100% capacity utilization. It doesn't work that way. So it will take a little while to get stabilized, to get the market going, which we are already working on the market in any case. So it will take some time. We will not get the full benefit of this financial year 23-24, but we will definitely get the full benefit of that in the year 24-25.
Correct, sir. And on the caustic market, sir, your takes, I think you mentioned that globally there has been no any big capacity addition. It is only the Indian market where 1 million ton capacity was added. So, taking into account the expanded capacity, what have been the average utilization for the country as a whole, sir?
I think the utilization in the country as a whole is running at about 72-73%, which is very good. Ours was a little higher, which is beneficial because we have a lot of our chlorine supply which goes directly by pipeline to many customers around our Gujarat factory. In our caustic soda factory at Kota, we use almost over 50% of our chlorine ourselves for make PVC and stable bleaching powder, etc. So our utilization was higher. But with the capacity coming in, you're right, it will take a couple of quarters to stabilize, and we hope the international economy also picks up or stabilizes, so the demand from there also picks up a little bit. Because ultimately, end of the day, today, whether it's caustic, you can just import it. There's no issue. So our objective is how do we actually have, going down the line, little balance in the capacity in India and international prices going up.
Correct, sir. I think just for the textile sector, sir, there was a big dampen in the demand from them. So how is the textile sector looking up, sir, for the month which has gone by? Have the textile sector opened up post the corrections in the yarn and the cotton prices, the inventory written down, and also I think so getting adjusted post the year? What's the outlook from the textile sector, sir? Any pillars you can share?
Textile sector discussions we've had and our people have had, the textile sector, as you rightly said, has gone down a little bit. And in the textile sector is important because it's used in the textiles also, as well as the dyes, etc., which are used in the textile sector.
Right.
Textiles are used in both. So we hope down the line with the Indian economy moving at 6% plus, this textile sector also picks up over the next few quarters, which should give us a little positivity.
Okay. And lastly, sir, on the power and fuel front, sir, if you could explain once again, sir, what led to this increase in power and fuel cost Q-on-Q basis also? Year on year, there is a significant jump of 100 crore. Even on Q-on-Q, there is a 40-45 crore change on even lower turnover. So if you could explain the mix that led to the explanation in power and fuel cost.
So, such power cost has been going up. Right. It is only in, let's say, by February, March, when the spot prices of coal started coming down. But the company carry for its operational safety. So that inventory, by March, we more or less liquidated the high-cost inventory, which we had bought in the month of November, December, January. And now we are seeing our fuel prices or the coal prices coming down, consumption rates coming down.
So can you share the mix, sir? What is the coal part and how much is the direct purchase from grid?
So about 38% we purchase from the grid for our chemicals complex at Bharuch and as well as Kota.
The balance 62 is coal-based. Coal and gas, both? Because I think for fertilizer it will be gas.
Primarily, but then we are also using biomass now in a big way. So we are using almost 20% biomass in Kota and nearing over 10% biomass in Bharuch.
Okay. So grid pricing, can you share, sir? How have the grid pricing shaped up for Q1Q or a year-on-year basis?
Grid pricing, that also keeps changing with the coal prices. So there's a fuel surcharge, but that ranges between 7 to 8 rupees.
Because I was just trying to make sense of this 9 to 10% increase Q-on-Q basis. Is it only because of the inventory factor?
That offline, sir. We will discuss that offline.
Okay, sir. I'll take it offline then, sir. Thank you for the.
Thank you. We take a next question from the line of Riya from Aquitas Investment Consultancy. Please go ahead.
Hello.
Yeah.
This is just in regards with the cost of production for sugar. You said that last sugar season it was 33 rupees and this time it's 32. This includes the 25 rupees incremental per quintal SAP increase?
Yeah, so even last year this 25 rupees was there. So this increase in SAP happened in the last season. So what JMD sir mentioned was essentially saying that the increase in SAP in the last season, which is 21-22, the sugar that is produced in that season is sold in the next season.
Right.
Mm. So that is where the cost increase had happened, but we didn't get the benefit in terms of the price, equivalent benefit in the price increase, and therefore the margins were lower. This year in any case there has been no SAP increase, but because of production and recovery, the cost is lower.
So can I know the cost of production for sugar season 21 or the year before the SAP increased?
That was close to about 2,950.
Okay.
I may be off by 10-15 rupees, but ballpark.
Okay, that's it from my side. Thank you for the clarification.
Thank you. We'll take a next question from the line of Ahmed Mehta from Unifi Capital. Please go ahead.
Thank you. I have two questions. First, on the epichlorohydrin realization. So we see that the prices of epoxy and ECH both have come down significantly. So in FY24, as we progress for capex, will we, based on the spreads which are on the spot basis, will we do break even for ECH? I know that we have the plans for long term, and the business will be very supportive for long term, but how should we look at the near term? Should we break even or no?
See, Ahmed, I think what you're looking at is, and if I'm not wrong, you're looking at the prices which you're right over last 1 year have come down from about 200 rupees per kg to now about 120 rupees kg. But then, even the glycerine price has halved. Like the crude glycerine is from 65 rupees a kg has come down to 32 rupees a kg. Right? So, ballpark my spread. So, if I look at my margin, my EBITDA margin is still in the range of around 20-24%. Yes, absolute number is lower and therefore quantum will come down. I don't deny that. But it is not, not under too much of pressure. I would say it is fine.
Got it. Yeah, thank you so much for that. And second question on the biocide. I know that I think this year we have done efforts to turn around the biocide business. So can you give some outlook? How should we look at FY24-25, and how does our product pipeline and product launches look for the biocides business?
FY24, we are looking at the same kind of a growth that we have seen in even more, because of the products which have been accepted in the market and because of some new good products which we have in the pipeline. And we are having products in almost all the crops that we deal with, whether it's cotton, corn, or paddy, or even vegetables. So I think FY24 should be even better than FY23, and we should be coming over the, in terms of turning around.
Got it. And over the long term, beyond FY24, FY25, how should we look at the business and the viable margins in the business?
Well, as of now, the long term looks good, but it has to be seen year on year. So because the market also, somebody else comes with a better product, but we also are very, very good and products. So we do see in the next 3-4 years we should be, growing and doing better.
Okay, sir. Thank you. Thank you so much.
Thank you.
Thank you. Anyone who wishes to ask a question may press star 1 on their touchtone phone now. As there are no further questions from the participants, I would now like to hand the conference back over to the management for closing comments. Over to you, sir.
Thank you. Ladies and gentlemen, thank you very much for your participation in our Q4 and financial year 23 earnings conference call. We are committed to deliver better earnings and growth. We are making efforts in that direction by growing our economies of scale, new product lines, increasing efficiency, fostering innovation, and promoting a circular economy and focus on sustainability. We also prioritize maintaining a strong financial position and continuing to look for new avenues of growth. Thank you once again for joining our call and wish you all good health always. Thank you.
Thank you very much, sir. Ladies and gentlemen, on behalf of DCM Shriram Limited, that concludes this conference. Thanks for joining us, and you may now disconnect your lines.